All right, folks, good morning. Last class, we talked about Chapter 1, which was the beginning of understanding investments. I just want to make sure everyone is kind of along the same place I'm in. All right, and that is that investments is deeply rooted in economic theory. So to really understand investments, you have to understand that it starts with the concept of wealth. And wealth starts with the concept of wages. So what happens functionally in every country in the world is that wages are paid for labor. Now, some people get paid more because they've got better jobs, or they're smarter, or whatever. But wages get paid for labor. From those wages, you pay for your basic personal needs. And the three basic personal needs are food, clothing, and shelter. Once you buy that, then it's a matter of what else do you want. Once you pay for whatever else you want, whatever's left over is wealth. And with that wealth, you do stuff, all right? And the stuff you do is to either save it and not spend it, save part of it and spend part of it, save part of it for a while and then spend it all, right? It's sort of an individual's call as to what they do with their wealth. Eventually, most wealth finds its way into the investment markets. And primarily, those investment markets are stocks, bonds, commodities, and real estate. And so if you look at the personal portfolio of even the richest people in the world, what you'll see really is five things. You'll see a component of cash, a component of equities, a component of bonds, a component of real estate, and in some cases, a component of commodities. And remember, commodities are not just agricultural commodities. There are also things like precious metals like gold, silver, even diamonds, and even art is in its own way a commodity. So given all of that, you've now got this broad place where people put their wealth. It's one of those categories. Right? That's what we're studying. So we sort of started out with the concept of, what are investment markets. The next thing is to talk about risk. All right? And so the problem with investing your wealth versus saving being putting it someplace where you get a very low return, but you also take no risk. And that's called kind of the risk-free rate. The problem with doing that is that you don't make much money on your wealth, and it doesn't drive productivity in an economy. So in a nation where everyone's a saver, they have trouble driving economic activity. And you can see that in some of the European nations. Some European nations have very high savings rates, meaning that people tend to save a lot of their wealth, meaning they don't take risk with it, they don't put it in the stock market, they don't buy real estate, right? And therefore they're having trouble driving the economy in those countries. So we're going to look at America, where the savings rate's relatively low. It's been a lot lower, but it's relatively low. But the investment rate is relatively high. And because of that now, we've got fairly mature, fairly good functionality in our markets in America. And those markets, because of the internet, have opened up very broadly to individuals, where individuals were sort of denied entry into those markets 10, 20 years ago. A good example of that is the currency market. So 20 years ago, if you wanted to trade currencies, you had to have a lot of money. And that pretty much was a place that only large banks, corporations, and very wealthy people would trade currencies. And quite often the trading was a hedging process, not really a trading process. So thanks to the internet, almost anyone can trade Forex now. And by the way, that's foreign exchange. And by the way, the lack of access to the currency markets is what drove the creation of cryptocurrency. So cryptocurrency is sort of a global currency that has a very high volatility factor where people trade it a lot. So now going backwards, if you will, we've got stocks, bonds, options on stocks, commodity futures, which are contracts between the owner of the commodity and someone who wants to eventually buy the commodity or make an investment on the price movement of that commodity. And so those are sort of your main markets, right? And in the bond market, you've got government bonds, municipal bonds, which are issued in the United States by the states and the counties and the cities, right? And then you've got corporate bonds. And all of that stuff, except for governments, has what's called credit risk, meaning that there's a potential for any issuer of debt to default. And in the United States, because we have such a mature bankruptcy process, it's a federal law, because we have such a mature bankruptcy process, issuers of debt do not have to pay interest or principal. And I know that sounds very strange, but because of the Bankruptcy Act, if you owe someone money in America, if you declare bankruptcy, you don't have to pay them back. You'll eventually have to pay them something, but you don't have to pay them back on time. You don't have to pay them back in full. And because of that, debt carries this credit risk factor that's very, very important.